Many traders spot market patterns and trends, and most of these indicators fall into two types, leading and lagging. Leading indicators is a tool designed to anticipate the future directions of the market in order to enable the traders to predict market movements ahead of the time. In theory, if the leading indicators give the correct signal, a trade can get in before the market movement and ride the entire trend. However, leading indicators are by no means 100% accurate, which is why they are often combined with other from the technical analysis. A leading indicator is a tool that provides delayed feedback, which means it gives the signal once a price movement has already passed or in the progress. These are used by the traders to confirm the price's trend before they enter at the trade. These indicators are commonly used by trend traders. They don't show any upcoming prices movements but confirm that a trend is underway. These trends to give traders more confidence that they are correct in their assumptions rather than providing a specific trigger for entering the market. So what's the difference between the leading and lagging technical indicators? The most obvious difference is that leading indicators predict market movements while lagging indicators confirm trends that are already taking place. Both leading and lagging indicators have their own advantage and drawbacks, so it's crucial to analyze yourself with how each works and decide which fits in with the strategy. Leading indicators react to the price quickly, which can be great for short-term traders, but makes them prone to give out the false signals. Conventionally, lagging indicators are far slowest to react, which means that the traders would have the more accurate but could be the late to entering the market. Lagging indicators react the prices quickly, which can be great for the short-term traders, but makes them proud to give out the false signals. Conventional lagging indicators are far slower to react, which means that traders would have more accurate but could be the late in the entire the market. Lagging indicators are tools used by the traders to analyze the market using an average of the previous price actions data. As the name implies, these indicators lag the market. This means the traders can witness a move before the indicators confirm its meanings, that the trade could lose the start of the move. Many consider this the necessary cause in order to confirm the greatest movement. Other views this as a lost opportunity of the traders are missing getting into the trade at the very start of the move. Lagging indicators often makes use of the price and input variable, and in most cases repeat the longer look back period in order to ascertain trends. Even with the delayed feedback, many traders prefer to use lagging technical indicators as it helps them to trade with more confidence by validating their trade decisions. Usually, traders make use to the two or more lagging indicators to confirm price trends before entering the trade. This can be viewed as the convertible way to the trade, but do not let this draw you into the false sense of the security that you can make the best decisions and make money consistently. Let's look at the classic example of the lagging indicators named by the moving average. In this setup, we add 50 period and 20 period moving average to trade to the golden and death cross, which are bullish and bearish crossovers of the 50 and 200 SMAs. Generally, the ERS is said to be the bearish when the 50 SMA cross below the 200 SMA, and bullish when the 50 SMA cross above the 200 SMA. In these charts, notice that the signals generally by the bullish and the bearish crossbones of the 200 and the 50 period moving average occurred very late. In the first signal, for example, if you went short after the bearish signal, it would have been the losing trade. This is basically by the time price moving lower and the moving average reacted to this price. Already fell significantly and started to the pullback higher. I've also read a lot of the false information regarding RSI, stochastic, and the other movement oscillators which were associated with the landing indicators category. No, they are not landing indicators, although these indicators will generate a lot of the signals if traded correctly. They will not land at the price. Just because they tell you how to observe the market doesn't mean that they are landing the price. Now, I'm not saying you shouldn't use like indicator because they can help you make informed decisions. Just remember that the lagging indicators can only provide today's value based on the historical data, since their indicators lag the price of the assets. A significant move in the market generally occurred before the indicators can provide a signal. The truth is that almost every technical indicators is a lagging indicators. Moving average, MACD, the RSI, stochastic, you name it, are lagging. First, there's the move in the price, then sometimes late in the game, the indicators signals by the sell originals. They lag behind the market actions. They give signals after the fact. It is really important for you to understand how the lagging indicators work and how the data is complied before in comparison to them to the trading strategies and risking capital. And those strategies, always remember that price movement indicators, not the other way around. This is why they always look profitable when you look at them at the left side of the chart, when the price actions is already unformed. When indicators are different, when indicators are indicators able to present the price movement of the asset due to their predictable qualities, while lagging indicators follow the price movement and don't have the reliable predictable qualities. When indicators are able to predict when the major movements in the markets would occur. Event technical indicators is designed to the anti-capture features price moves in order to give the edge at the magical as the sounds. The land indicators relies upon the most common variable price. Land indicators will allow you to update future price movements, and therefore you will be able to enter the trades properly at the start of the move. The downside is that the traders are anticipate and move before the actually happens. The market could move the opposite directions. As a result, it isn't uncommon to the writers first that just went behind the major restrictions. So, which indicators or tools I consider to be landing indicators? Well, pivot points are landing indicators. Pivot points are levels that were used with the floor traders to determine the direction of the movement, and potential support to resistance levels. By analyzing today's height and low and close, you are able to calculate the next day's pivot point as well as potential support and resistance levels. Part of what makes the pivot points so reliable is the fact that they are based on purely on the price. Plotting the levels allows you to know advance some key levels for the next day. you know that if the price reach this area, for example, they will be able to rejection or the breakdown. Fibonacci retracements and experience are also ending tools. This means that you can decide on the likely different direction ahead of the happening on the combat to landing indicators which only predict movements after it has already started to occur. As Fibonacci is the landing indicators, you will see the entry point of the place and order in the advance of the making place reaching your decision level. Other traders also consider volumes as the landing indicator, but only in the conjunction with the price. Trend lines, support and resistance levels can also be considered landing tools because you can plot them on your chart and find levels where the price can reach. Landing indicators tell you ahead of the time where the market is likely to find the support or where the market is likely to find the resistance. Now, should you use your running or the lagging indicators? For traders, it is often to the dilemma of the finding a balance between them. Really on the landing indicators is the chance that you will see a lot of the false signals. Rely only on the lagging indicators, you will likely enter late and hold on your trades too long and give back most of the profits. Traders looking for the fast signals will trend to the factor landing indicators. Traders seeking a general degree of the confident will tend to favor lagging indicators. The trick is to achieve the proper balance by mixing landing and lagging indicators across time frame. If you can accomplish this objective, you can come up with the trading approach which is far superior to using entire of the two exclusively. With those obvious drawbacks, it is best to develop the trading strategy that combines both leading and lagging indicators. For example, you can use lagging indicators like 200 EMA and the leading one, the pivot points. First, determine the context for the traders using the lagging indicators. So if the price is below the 200 EMA, we have downtrend, and above 200 EMA and uptrend. The establishment the entry level using the lagging indicators, namely the pivot points. You can buy the pullback of the example the central pivot point when the marketplace is about 200 EMA, the direction of the trend. You can continue to the use of the lagging indicators to find the stop placement point, meaning your stop loss order. In the case of the uptrend, this would be the boundary substantial support level, maybe below S1 level, or you can find yourself Fibonacci retracement and of the oscillator like the stochastic again a level and the lagging tools side by side. You can enter the after the stochastic divergence or the oversold stochastic when the price rejects an important FAB level. Again, try to find the proper balance by the mixing landing and the lagging indicators with the aim of the stacking the odds in your favor. If you learned something new and found value, leave us a like to show your support, subscribe to our channel and stick the bell icon to stay in touch when we upload the new videos. Until next time.